The primary question we're getting is, should I add to my accounts right now? We're not seeing any panic or concern at all among our clients. They're instead either sitting tight, shrugging it off, or wondering, can they invest more?
Yeah. Let me just point out, we said a little while ago that the Credit Suisse would be liquidating the XIV on January 20th. They meant February 20th. January 20th is already passed here. Ed?
Good prediction.
Yes, I know. And so what are you telling your clients right now?
Also, it's a buying opportunity. You know, you got to look
if you can get in.
If you can get in. But I'm talking about in retirement accounts. Those are long-term investments anyway. Your 401k, your IRA. This, combined with the new lower tax rates, may be a buying sign to do a Roth conversion now and move some of that money into a Roth. And the rebound will be all tax-free. But you have to be careful, because the new tax law changed the rules for Roth conversions. There's no going back. So you have to know what you're doing. Maybe some dollar cost averaging into Roth IRAs over time to smooth it out. And there's another play you can have. IRS recently gave us a ruling on last year's conversion. So you still have time to undo the conversions that you did in 2017. If that has tanked, maybe it's a play like an arbitrage to undo those. You'd have to look at the value and then reconvert at lower rates, lower rates and lower values. That combination is very good for retirement investors looking to push into tax-free territory long term.
Rick, you mentioned that people aren't panicking about their stocks. What about on the bond side? Here's a question that we got on Twitter. Jess asks, at what point do I put all my 401k in bonds temporarily? What would you say to that?
Oh my goodness. Yeah, that would be the absolutely wrong thing to do at the wrong time for all the wrong reasons, especially if you're talking about long-term bonds. People need to recognize that during a market decline is not a reason or an opportunity to change your investment strategy, and certainly not going into long bonds now while interest rates are rising, because as interest rates go up, bond values go down. It's a terribly wrong thing to do at the wrong time. That person needs to stop being their own advisor and go hire a real one.
Well, and people tend to overthink things too, you know.
And very emotional.
And everybody says they have a long-term time horizon until they don't.
It's like when the financial advisors ask you, they do a risk tolerance questionnaire, and you say, yeah, I'm okay losing 20%. Right. It's a lot different saying you're okay losing 20% than actually losing 20%.
But let me point this out. We are saying that there are those who say the market looks more attractive today than it did yesterday or Friday. But I would point out that at these levels, at 24/7, these are levels we were at in early December. And when we were there in early December, people were saying the market was overbought at that point.
Right.
But now suddenly
you're absolutely
looks attractive. Right? I mean,
yeah, that's why we have to change our perspective correctly. In other words, it's not looking back at last December, because you're right, that's silly. What we need to do is look at the December 10 or 20 years from now. By that metric, we'll turn around and say, gee, 10, 20 years ago, 2018 was a bargain, and that's the only metric that really matters.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.